Good afternoon again. My name is Teresa Roberts. I am COO and partner here at Curo Private Wealth, and I'm so happy to be joined today by our investment committee members, and I will take a moment to introduce everyone you see here on the screen. So we are joined by Ann McCabe, CEO and partner here at Curo, by Managing Director Jane DiVincenzo, here joining us from the Richmond area, Xander Cochran, our investment and planning associate, who, shout out to Xander, has done a lot of work on the presentation you're going to view today. Manny Carranza, financial advisor here in our Rockville office, and Carol Castillo, which may be a new face for some of you if you've been on our webinars before, financial advisor here in our Reston office. So we're going to go ahead and get started. We want to make as efficient use of your time as possible. So we will start. Of course, our webinar today is a review of 2025, both economic and market, and also some outlook for what we're anticipating for this year. So we'll start, as we always do, with just a general recap of what we saw last year. 2025 ushered in both a new administration, and with it came widespread political uncertainty. We saw the highest tariff rates since the 1930s, mass layoffs due to DOGE cuts, the longest shutdown of the federal government we have seen, and growing geopolitical tensions. The Federal Reserve continued in its rate cutting cycle, lowering rates by 0.75%, though inflation remained sticky. Core inflation was near about 2.6% by year end, which is above the Fed's ideal 2% target. AI excitement, what I like to call euphoria, and spending fueled the market rally and economic growth last year, contributing significantly to real GDP. And while US stocks had a third consecutive year of double-digit returns, international stocks shined, outperforming the US. Markets were volatile earlier in the year due to tariff concerns. After the announcement of reciprocal tariffs on April 2nd, US stocks sold off and nearly reached correction territory over just a matter of days. But markets, did rally strong as investors shrugged off bad news and strong corporate earnings prevailed. Labor markets did soften, ending the year with the weakest job gains since 2020. Now, to take a look at our market review, all asset classes had positive returns in 2025. US stocks ended at 17.4%, but were eclipsed by both emerging markets and developed international stocks. Both ended the year with greater than 30% gains, benefiting from a weaker US dollar and also cheaper valuations. Relatively high interest rates helped to support bond returns in 2025. Core bonds had their best returns since 2020, and strong corporate profits also boosted demand for corporate debt. Commodities finished the year strong, but were a mixed bag. While energy underperformed, stellar gains in precious metals led to double-digit returns for the asset class. And now to dive a little bit more into our asset allocation diversification, I will hand it off to my colleague, Jane DiVincenzo.
Well, thank you. Noting a similar theme, and I'll apologize in advance for the folks that make this slide. It's not us, for all the pink. But last year, pink was a hot color. That is the box that shows international stocks. And as you look at this slide, you'll notice one major takeaway: no asset class stays on top every single year. That's exactly what we saw last year with international stocks outperforming, as Teresa noted. And they outperformed after a long period of US leadership, and not because US companies suddenly became bad, but because markets move in cycles. And so what changed in 2025? Again, as Teresa said, the dollar weakened dramatically. It was down 11% in the first half of the year, the worst performance in 50 years. Policy uncertainty around tariffs and Federal Reserve independence shook investor confidence, as we saw that sell-off that we had that gave folks the jitters. And then when markets questioned whether America still deserved its premium place, capital started flowing overseas. Second, interest rates. As the Fed cut rates while other central banks stayed higher, the yield advantage that made U.S. asset attractive narrowed. So lower rates typically mean weaker currency, which isn't so good for some U.S. stocks. And third, valuation. A lot of clients mentioned to us that they thought U.S. stocks were maybe too expensive and concentrated in a handful of mega cap names, while international markets were priced more conservatively. So for international investors, this was a double win. Strong local returns and currency gains really helped when converted back to US dollars. This chart reminds everybody why diversification matters. We think it's really important because we can't predict next year's winner, who's going to be on top. So we don't bet everything on the trailing 12. It's really important to cover all these boxes when we build a strategy for you. So diversification won't win every year, but it helps manage risk, which is really important to our clients. And then this chart is a helpful take a deep breath kind of chart. This reminds us that in a typical year, and this slide goes back to 1980, during the course of a year, we might see a drop of 14.2% on average. But in 35 of the last 46 years, the market's still ending the year positive. So when we get those jitters like we did at the beginning of 2025, we saw that investors who stayed the course were rewarded, just as historical data indicates.
So on this slide, it's building on the last slide Jane was discussing by giving an overview of the S&P 500's annual returns since 1928. So from left to right, the columns represent how many years there were annual returns that were on the far left worse than negative 20%. And then on the far right, it shows greater than positive 20%. So what stands out is that the market has had greater than 20% returns 36 times, which is more than the market has had negative returns overall. And since 1928, the market has had positive returns 73% of the time and has most commonly had returns greater than 10%. This is important because it reiterates that although we'll likely see periods of volatility during 2026, the market has historically had more good years than bad. And on our next slide here, we're discussing the dot-com peak versus the AI bubble. So two questions we've been hearing a lot from our clients is basically, are we in an AI bubble and how does it compare to the dot-com bubble? And these are great questions because visually they look very similar. Stocks are rising, tech is leading, and there's optimism around innovation. So on the surface, it feels like the dot-com era. And what this graph is showing us is how much of the returns of the S&P 500's tech sector on the left and the S&P 500 on the right were attributed to earnings per share, which are represented by the blue bars, and then price to earnings ratio, which is represented by the gray bars. So if we look on the left-hand side, when looking at the tech sector, the left column there represents the dot-com bubble, and you can see that the growth was primarily attributed to the price to earnings ratio, which means that investors were basically just paying more per dollar of earnings and not because of the profits. So in contrast, when looking at the column to the right there, which is representative of 2025, you can see that the growth was primarily attributed to earnings per share or to future profit forecasts moving forward. Now, if we look at the right-hand side there, this is, again, showing the S&P 500 in general, and you can still see that earnings per share was a bigger driver for growth in 2025 than during the dot-com bubble. But overall, the difference is that although there was strong market performance during both periods, 2025 and the dot-com bubble, the 2025 rally was primarily driven by improving earnings per share expectations, as opposed to price to earnings expansion, which is greatly different to the final surge of the dot-com bubble.
Thanks, Manny. So continuing with what Manny was presenting, in this slide, we take a deeper dive into the S&P 500 index concentration, and we analyze the Max 7 companies. These are the technology companies that have been driving performance for the past couple of years. And these are, of course, NVIDIA, Meta, Tesla, Amazon, Alphabet, Microsoft, and Apple. So if we look on the right-hand side, we have a breakdown of the index composition into the Max 7 and the rest of the index. The Max 7 accounted for 63% of returns in 2023 and 55% in 2024, propelling the market to reach back-to-back years of over 20% of returns. However, the same Max 7 can also drag the market lower, as we see in 2022, where they accounted for 56% of the market sell-off. In the bottom graph, we have the annual earnings growth of the Max 7 versus the rest of the S&P 500. After contracting in 2022, we see an impressive recovery of the year-to-year earnings growth, and also a slowdown in 2025 and a slowdown for a projection of 2026. For the rest of the index, analysts are expecting an acceleration of year-to-date earnings growth. Now, while both remain impressive levels, the data shows that the Max 7 returns have moderated in earnings growth. So if we continue this analysis to the graph on the left side, we can see that in 2023, the Max 7 crushed the S&P 500 index, while in 2025, only a couple of those companies really outperformed the index. So now in terms of our themes, we have transitioned from a cautiously optimistic view for most of 2025 to a conditionally favorable view for the beginning of this year. And really, this is based on the unexpected market resilience and ongoing uncertainty and volatility. Now, with this in mind, especially thinking of the portfolios that have frequent distributions needs, we have been able to maintain ample liquidity, really in order to reduce risk of having to raise cash during less favorable market conditions. And now to my colleague, Xander.
All right. So looking off, as we like to do for our economic dashboard, this time want to start with what the dashboard looked like at the start of 2025. So if you joined us a year ago, this is the dashboard that we showed then. And then if we flip to the next slide, we can see ever so slight shifts across all 5 of these different dials here for the economy. If you want to do one more switch, just so kind of go back and forth to see the differential between the two. So essentially what we have here is 5 different aspects of the economy from where they are to a positive to negative territory. Starting off in the beginning of the year, we saw everything really in the neutral territory, and then the shifts that we saw over the course of the year. First, we saw monetary policy was the only one that shifted higher, and it was ever so slightly higher, really to that in between positive and neutral. Really, as the Federal Reserve continued cuts in 2025, as Teresa mentioned, by 0.75 percentage point. But the Fed has had a little bit of a harder job, just as their mandate is to keep inflation low and also keep unemployment low, or have maximal employment. And both of those numbers kind of went the opposite direction at some point, as we saw the labor market soften throughout the year, and then inflation largely around tariffs and the effects theirs did move higher at parts of the year. For manufacturing, that shifted a little bit slightly more into the neutral territory towards negative, just as manufacturing hasn't really come around and has been stuck in neutral territory for some time. The consumer overall, this shifted a little bit lower negative as well, although we're still seeing strength on the higher end of income earners for the consumer, going out and being able to take their wages that they're earning and going out and spending that money. those at the lower end of income earners are definitely struggling more. So that's the, you may have heard of the term, the K economy right now, just as one side is moving higher, the other side is moving lower. But we also note that consumer confidence for the whole year has been stuck in a rather low territory compared to historical measures, which I'll get to in a second. Housing is the one dial that's moved into negative territory, just as we've seen the housing market overall really slow down a bit more. Affordability is still an issue for people trying to buy a new house. We've seen mortgage rates come down a little bit recently, but overall still inventory levels for houses have moved higher. We've seen the list prices for houses move down a little bit lower, and overall just kind of a rocky place for the housing market right now. And then lastly, for the labor market, what we see is a very strong, steady slowdown throughout the course of the year. The unemployment rate has ended at the year at 4.4%, which is still lower than average for historical record or standards. But we definitely see those trying to find a job struggling a little bit more, and the overall labor market has definitely weakened a bit. If you could go to the next slide, please. Looking a bit on inflation, and this time it says official inflation has decelerated in recent months. We saw inflation ramp up towards the middle part of the year, really around tariffs and the effects there. It did take a few months for tariff inflation to really factor in, and that's mostly can be seen a little bit hard to see in the orange. So the core goods really being affected by tariffs the most. Did want to mention that. We have seen the inflation, the core headline inflation number come down in Q4, but did want to note that the official information that's come out was affected during the government shutdown. So with the government shutdown for about 43 days, some of the survey data that was used for housing inflation was not collected during that time. And so basically that number was put as flatline when realistically, if the government was able to use that or collect that survey data, it probably would have been higher. So it's probably safe to assume that the official inflation data is a little bit understated. JP Morgan, which this chart is from, believes that the realistic number is probably about 0.1 or 0.2% higher than what that would be. So currently at 2.7%, it might be more like 2.8 or 2.9 for if that owner's equivalent rent part of the shelter inflation was factored in correctly. Then next, just looking a little bit at the labor market data. We have been focusing on this a bit more, just as we did see in Q4, the average payroll gains actually go into negative territory. So overall, there is job losses. This is really most attributed by the number that came out of October, which is really when the DOGE cuts affected the labor market. So although the cuts happened earlier in the year, employees from the federal government who got reduced in force there were technically still employed through September 30th. And so once the October number rolled around, that's why you see a big decrease in the month of October. That was negative, which puts us in average over the past 3 months at negative 22,000 jobs. Also noted is the Federal Reserve believes that these numbers are probably a bit too optimistic as well. Typically, we see revisions happen over a 6 and 12-month period. So I would say do not be surprised if we see revisions later on that makes this actually look a little bit worse than what the current stated numbers are. But despite that, we do see unemployment level, as I mentioned, at 4.4%. It's lower than the historical longer-term average at 5.5%. So at least it's not falling off a cliff. It's more of a steady, slow slowdown that we see for the labor market. And then one other thing affecting that is affecting is the slowdown in the labor market is affecting consumer sentiment. That's at least one of the factors that's affecting consumer sentiment, which I noted is not looking so hot right now. People don't feel great about the economy, even though the economy is doing okay. From the data perspective, a lot of people don't feel great about it. Part of that, I believe, is the political uncertainty that we saw throughout the year. But then also part of it is the softer labor market. If you are working, but you're not as certain about your outcome or the future for job prospects in the future, that's probably going to affect how you spend. You may be a little bit more cautious, might not feel as confident about the economy overall if your source of income is not as confident as well. So that's really what this is showing. Historically, over the long term, we see a pretty strong correlation between the green line, which is consumer sentiment, and the blue line, which is the monthly change in non-farm payrolls or job growth over the year. There is a large discrepancy, however, since COVID, where that kind of bifurcated a little bit, where people feel worse, and that hasn't really recovered over the past 5 or so years. And then next, I'll hand it off to Anne to wrap us up.
All right, awesome. Thank you, Xander. So I'm going to talk a little bit more in depth about AI, something that I'm sure you all have been hearing a lot about. So what we're looking at in this chart is the relationship between AI adoption and the change in unemployment across industries. And this is grouped by how aggressively those industries have already adopted AI. And the key takeaway here is that the industries with the lowest AI adoption, which we see in that thick teal line, have actually experienced the steepest increases to unemployment from 2023 to the end of 2025, which is both counterintuitive and also contrary to the common narrative that AI is already taking jobs. So although AI could certainly be a headwind to the labor market in the future, so far the disruption has been pretty manageable thus far. So we'll see what the future holds. So now let's take a look at what is happening on the infrastructure side of AI, because this chart does a really nice job of highlighting both the scale as well as the acceleration of the investments that we're seeing behind the scenes. So what we're showing here is capital expenditure, or CapEx for short, from the major hyperscalers. These are companies that we are all intimately familiar with. Amazon, Alphabet, Meta, Microsoft, and Oracle. And these companies are essentially the backbone of both cloud and AI infrastructure. So if you look at the left-hand side of the chart from 2016 to 2021, we see that spending grew pretty steadily, but relatively modestly. And then in late 2022, with the release of ChatGPT, we see CapEx just surge up and to the right. And as you can see, the total hyperscaler investment is expected to increase by 3.8 times by 2027 and hit a collective over $600 billion of annual CapEx spend, which is just an extraordinary amount of growth and an extraordinary amount of money. So I think the story here is that AI has become a major capital investment in the economy and one of the most significant drivers of growth that we're seeing in the market today. All right, so a couple charts that you have probably seen if you have tuned into our webinars before. We like to end all of our webinars by zooming out. So far we've been talking a lot about the short run, which is what happened in the markets in 2025. This is zooming out, about 225 years roughly of data, showing if you took $1 back in 1800 and you invested it in the US stock market, what that would have grown to by the end of 2025. And this is adjusted for inflation, which is an important factor. So $1 would have grown to about $2.8 million in the stock market. And then you can see what that $1 would have also grown to in a few of the other asset classes, including gold, which has gotten quite a bit of attention recently. but that dollar would have only grown, even with the recent increases that we've seen in gold, to just over $6. So there's a quote here by Professor Jeremy Siegel, which we like to highlight also. And that is that stocks are the most volatile asset class in the short run, but the most stable in the long run. So we love this chart for a couple of reasons. Number one, just to demonstrate that when we're talking about growing our wealth, the best place to do that over the long run has been in the stock market, and we believe that that will continue in the future. And then this also does a nice job of helping us to stay committed to our long-term plans, to being long-term investors, and hopefully this will help as we go through bumps of volatility, which we are very much expecting this year. And then the last visual, again, which you've probably seen before if you've tuned in, this is a visual of our philosophy at Curo and how we love to work with our clients. We always start with the whys of life. For most of our clients, that's their family, occupation, getting to a work optional lifestyle, recreation, that bucket list. And then we talk about the money, which is a means to an end. It's a tool that helps us live the life that we want to live today and in the future. And then we go to the control circle. So we try to spend very little time worrying about things that are outside of our control. And certainly in today's day and age, there is a laundry list of things that we could all be worried about and we could spend a lot of energy on. But we would argue that if it's outside of our control, that is probably unproductive energy. And what we really should be focusing on from a financial standpoint is having and working a financial plan, having the appropriate mix of stocks and bonds in our portfolio. And then lastly, and this one is hard when things are going kind of crazy around us, but it's maintaining our emotional centeredness, really staying grounded, staying focused on the long run, making sure we're not making short-term emotional, irrational decisions based out of fear. So this is where we love to live and to operate with our clients, is right in the middle of those two concentric circles, where the what matters to you and what we can control come together. All right, so I think that wraps for the prepared remarks that we had, but we are happy to open up for questions. One of the nice things about doing these live client webinars twice per year is you get the opportunity to ask questions live. So if you have a question, feel free to drop it in the chat box, I believe, Teresa, that's the place to put it. Yeah. So feel free to put it in the chat box.
Yes. So I'm going to stop share just so that we can see the gallery here. But there is a Q&A option available in your Zoom structure. So feel free to drop a question. You can choose to do it anonymously, but we will hang on here for the next few minutes to try to entertain any of your questions. And while we are waiting, just want to panel the committee here. Anybody feeling anything strongly they want to share with our clients today about 2026?
I think what Anne highlighting, I'm sorry, Anne.
No, it's okay, go ahead.
Highlighting what Anne was saying, just keep it in mind, the long term is so important. You know, the saying or the compliance line that we always say is, past performance doesn't guarantee future returns. You know, we've seen the stock market done some very unexpected turns this past year. But keeping a focus on the long term, I think, is really important. So I think that's something to highlight.
Yeah, absolutely. And I was just going to say that we talk a lot with our clients about cash management. So in addition to diversifying from an investment standpoint and a tax standpoint, we also want to make sure if you are a client who is taking distributions in the distribution phase of your life, that we're also very proactive about raising cash. And one of the points that Carol made on her slide was we don't want to be in a situation where we have to raise cash, which just means we're selling investments for you to generate cash for your paycheck. We don't want to be in a position to do that when the markets are down. So that is something that we are extremely proactive about, is making sure that we've got a nice sound cash buffer for you so that when we do see the downturns of the market that are inevitable, we can just ride that wave out and you'll still have cash, you'll still get your paycheck and be just fine. And when things come back up, then we can replenish your cash. Anybody getting a frequent question from clients that would be helpful for us to address for everybody? Aside from is AI in a bubble,
Is
which
AI a
Manny,
bubble? Is
yeah, which
always the big
Manny,
one.
right, Manny went through in his slide, but
I
any
guess
additional? Yeah.
I guess one thing that I'm eager to hear a resolution on is tariffs. You know, when the Supreme Court comes out, if they side with Congress is in control, I think we'll see a rally in the markets, a lot of confidence come back in the markets. So I think folks need to be careful about trying to, play the odds. I guess a lot of people are on the news of the day, and just wait patiently for things to settle out. But that could be very good news for markets.
Yeah. So we have received a question from our audience. And the question is, since AI infrastructure is growing boldly, are you looking to invest in these companies? And I'm not surprised that the question is AI related. Anyone want to take that one?
I can start off there. So yes, especially the Magnificent Seven, they're some of the largest companies within the S&P 500, and we're pretty much always going to have exposure to the largest names within the index, just by having the index itself as a portion of your portfolio. So in a way, we are pretty much always going to be invested in these companies. It's more a matter of how much exposure do we have to them. We did bump up our exposure a little bit to large cap growth US companies, which include a lot of these names. Last year, we had been a little bit more overweight to value companies and then switched a little bit more towards growth US companies. So that gave us a little bit more exposure there. But I would say overall, we're still a little bit cautious on just the outlook overall. Don't want to have too much exposure, because even though things look pretty decent, not comparable to the dot-com bubble quite yet, doesn't mean that we couldn't get to that point over a couple of years, if the trajectory really kind of continues on the same path. So yes, we are invested. We're as a committee constantly looking to see what that right balance is to have that invested, and did increase a little bit to large cap growth last year.
Yeah, and I also like to share with clients that it's very hard to be invested in the US and not be invested in AI. The slide Ann went over talking about the hyperscalers. Many of those companies are the Mag 7 companies we talk about. And even in preparation for this webinar, we discussed just the amount those companies play in the returns we see in US stocks. I think it was over 40% of the returns we got last year of the S&P were represented in those top large companies. And those are the AI hyperscalers. So when people say, how do I get invested in AI? If you own the US stock market, you're invested in AI for certain.
Yeah, you'd have to try really hard to be
To
invested in
avoid
the
it.
US and avoid it.
Kind of to that point, back to diversification, folks who just were all interested in US and AI missed out on the international run last year. And if the Fed lowers interest rates again this year, we could see the dollar continue to weaken. And again, that's a boon for foreign stocks. So I've been trying to make sure that my clients have an appropriate allocation to international markets, because for several years we were sort of underweight because of underperformance. But with the weakening of the dollar, I think there's still opportunity in international, and we're making sure folks have an appropriate allocation to that depending on their risk level.
Yeah, for so many years we were waiting for international to have its day, and international finally did in 2025.
Yeah. And we had a few years there where it was like a fake out, right? Like the
Right.
first quarter, international would outperform US, and we were like, oh, maybe it's this year. Nope, not this year. But 2025 was the year.
Yep. All right, so we do have another question here. What is your view of the oil market due to Venezuela?
Ooh.
Don't all jump in at once.
I can jump in. Yeah, so my thoughts are that there's a lot of uncertainty regarding what exactly will happen with the oil market. I know a lot of people feel optimistic, at least for those who live in the US, because they feel like we're going to have access to more oil reserves. But I guess one of the biggest issues there is that the infrastructure isn't very well established. So then, as far as us benefiting, or I guess I couldn't say that I'm like super optimistic about it, at least in the short term, just because the infrastructure isn't there, and then it will have, or we will, well, the US will have to start investing in Venezuela to get everything up and running. So I think at least in the short term, my outlook is that it might stay steady while everything shakes out. But happy to
And
hear everyone else's thoughts.
yeah, and on top of that, the type of oil in Venezuela they have is difficult to get to. There's a lot of uh, bifurcation in the country where there are parts of the country run by gangs. The country's kind of a mess still, what's going on there. But the oil itself is a thick, gloppy type of oil that's not easy to convert into gasoline, for example, and things like that. So I think to Mandy's point, there's a lot of expenditures that corporate America or whoever's going to be investing down there is going to have to make before we start seeing returns. We monitor, my family has this big thing monitoring gas prices all along the main thoroughfare in Chester and Richmond. And we had a nice dip a few weeks ago, but it's been creeping back up again. And we're like, what's going on with that? So any day you want to know the price of gas, you can ask my 23-year-old and she can tell you to the penny because she watches it like a hawk. But anyway, I don't know that it's going to help us on our gas prices anytime soon.
Yeah, there's also still OPEC, that small organization called OPEC.
Just
Yeah.
a small one.
Yeah.
And we're exporting a ton. We've been doing this for decades of natural gas to Europe. So some of the tariff war could impact our ability to export our natural gas surplus here. So that's something kind of to keep an eye on as well, is depending on what happens with other countries and trade and what have you, that could actually hurt revenues in the US on the sale of what we're producing here. So the fact that we want to go and pull more oil out of the ground, it's Econ 101. Everybody remembers in college, you got too much of something, the prices go down. So if we keep cranking out tons of oil and gas, we're just going to see prices go down, which doesn't necessarily make OPEC happy, corporate Exxon happy, but it might help us. But again, that's a whole other thing. So anyway, but good question. That's a very hot topic.
I don't see any new questions, and we're coming up on just a 1:15. So we'll wait maybe 90 more seconds, committee, and see if anything pops in. But of course, like we shared in our presentation, you all know how to reach us. If you still want to submit questions that you thought of course, reach out to any one of us, whoever your primary advisor here. We work as a team, but you can always send us an email. You can use the info@Curo Private Wealth. You can email us directly. We're always ready and willing and able to support you and answer your questions. And we did get one last one. This is not technically a question, it's a comment, but there's no questions, but thank you for all of your insights.
Oh, you're welcome. Thanks for tuning in.
This was meaningful to you guys. You found something useful for it. And of course, as we prepare for our reviews in the coming year, these are more things that we will talk about as things evolve. The committee will also come with updates every quarter. Of course, one again will be live, like this one, where you can ask live questions. The other two recorded. But we always want to stay in front of you with up-to-date information about our views of the economy and the market.
Yeah, just a quick plug too for our social media channels. I don't think we have a slide for that this time, but we are on most all of the social media platforms. We're not on TikTok. Sorry, unfortunately not on TikTok, but Teresa wants us to be on TikTok, but I keep saying no. So, but we're on YouTube and we are very active on YouTube, Instagram, Facebook. All of us have LinkedIn profiles and we do update those regularly. So instead of you waiting until the next market update, please do check out those channels, whichever is your favorite. And we are pretty active updating with interesting information there too. So just a little plug.
All right.
Oh, and Teresa and I do a
And the
podcast too.
weekly
So
podcast.
yeah,
Don't forget.
that podcast. Thank you, Carol. Well, thanks everyone for tuning in. We appreciate it. As Teresa said, please feel free to reach out. We're so grateful for your time, for your attention, for allowing us to do our life's work, to be a part of your financial journeys and your lives. So thank you so much for that honor and privilege. We do not take it lightly, and we are very grateful for it. And we look forward to catching up with you all in real life sometime very soon.
Hey, thanks. Take care.
Thank you. It was great. Thanks.
Bye.
Bye, everyone.